Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 286 of the Independent Advisors Podcast, where Mark McEvely and I, Matt Jessup, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, I'll be conducting the podcast solo. So before we begin, I'm going to quickly review the year-to-date performance of the major indices that we track. And this data is going to be from Y charts and as of the market close yesterday on January 29th. The S&P 500 index year-to-date is up 2.68%. The Dow Jones Industrial Average is up 5.10%. The Nasdaq Composite Index is up 1.67. The IWM, which is the Russell 2000 Small Cap ETF, is up 2.39%. The Vanguard ex-United States ETF is up 3.15%. And then converting over to the bond markets, the yield on the 3-month Treasury is at 4.29, the 2-year at 4.2, and the 10-year Treasury yield is around 4.5%. So let's kind of dig into big headlines and current events. It's been an eventful past week. I'm going to start and I'm going to talk about the debut of a new AI model from China called DeepSeek. And I'm sure you probably have heard about this in the news headlines yourself, independent of this podcast. So this news sent the markets into a frenzy on Monday. DeepSeek, which released its open source models for download in the US earlier this month, it surged to the top of the Apple App Store downloads chart. It's been compared favorably to products from OpenAI and Meta, while appearing to be more efficient and cost-effective. The competition from the Chinese company spooked investors, hitting tech stocks especially hard as the Nasdaq had its fourth worst day of the last 2 years. Semiconductor designer and AI darling Nvidia plunged, and I'm using the word appropriately, 17% during market trading this past Monday, and that's equating to a loss in market capitalization of $589 billion with a B. That is by far the single greatest one-day value wipeout of any company in history. Meanwhile, President Trump praised DeepSeek, calling it a positive development and a wake-up call for U.S. industries. So, there were some individuals coming out critical of this news. For example, Elon Musk and Alexander Wang suggest DeepSeek has about 50,000 Nvidia Hopper GPUs, not the 10,000 A100 chips that they claim due to U.S. export controls. Musk, with experience from XAI, agrees with Wang's assessment. Another critical data point was from Reuters on January 29th, and this was released at 9:55 a.m. Quote, DeepSeek's chatbot achieves 17% accuracy, trails Western rivals in NewsGuard audit. The chatbot repeated false claims 30% of the time and gave vague or non-useful answers 53% of the time in response to news-related prompts, resulting in an 83% failure rate, end quote from Reuters. So listeners and viewers, this is kind of my editorial opinion regarding the topic. There's going to continue to be dramatic evolution in the AI space, not only in the next couple of years, but over the next decade. You're going to continue, I think, to see headlines that XYZ company has developed a more efficient model to track this. And kind of where I stand on this is the path of least resistance is they're going to need manpower. And the manpower in this example is the hardware as it stands today. They're going to need these graphic processing units. Even if the AI model becomes more efficient, which you would continue to expect that to occur, it just begs the question for the market, do you think the AI spending boom will stop anytime soon? And I don't, but in my opinion, there'll be peaks and valleys like any other spending cycles. It's not going to be quarter after quarter, though it could. But, this type of news I don't think is going to, quote unquote, in my opinion, completely derail the market. And you've kind of seen cooler heads prevail after that sell-off Monday. And you definitely, in my opinion, saw a lot of the stocks that got hit on Monday catch a bid. Second thought to this is when you see these dramatic headlines, and I'll quote back again, that AI darling Nvidia was down 17%, losing $589 billion in market capitalization, by far the single greatest one-day value wipeout, ... As these large mega cap stocks continue to have huge market capitalizations, yes, they're going to have normal movements in sell-offs and gains that are double digit. And I have a piece in a little bit that talks about the historical volatility of Nvidia. And guess what? These types of movements are not uncommon when you look at the history of the stock. However, now that the market capitalization is as big as it is, you're now seeing the dollar equating to it a lot more dramatic. So I just want to throw that out there. On a different note, I found this news headline really interesting. Incoming Health and Human Services Secretary nominee, Robert F. Kennedy Jr., you might have seen some of the headlines yesterday as he was being grilled by the Senate in his nomination committee. He said he's planning to move cannabis off Schedule 1 and the government will start collecting taxes on it. He forecasted it will generate $8.5 billion in revenue and said he wants to dedicate that revenue to wellness farms, drug rehabilitation farms, and rural areas all over the country. This makes me think about the business dynamics of where, say, some of that money is currently spent and how that could affect some various different businesses. I think you can, draw your conclusions on your own when I say that. So next, we will transition to tweets, articles, and research from this week. I'm going to start again about the sell-off that we had on Monday. And the first piece I'm going to be talking about is from Bloomberg, and the source date on this is January 28th at 7:16 a.m. And the title of this piece for me is The Underlying Stock Market Health. And for those, my traditional podcast listeners, I'm using the air quotes, health. The stock market health better than the headlines would lead you to believe. So this is from Bloomberg. Monday's rout has enhanced market breadth. Consumer staple stocks had a great day and have now outperformed technology since the election. Jenna will put up this chart for our YouTube viewers. It'll be in our show notes for our traditional podcast listeners. And this piece from Bloomberg goes on to say that Truist, it's a bank and they have a research arm. Truist Lerner, who's the individual there, observes that money is rotating within the market. Although AI-related stocks fell sharply, the S&P 500 Equal Weight Index, a proxy for the average stock, was down less than 0.5%. With 4 sectors trading higher at the time of the writing. If there is a silver lining, the rotation underway could lead to somewhat of a more balanced near-term market. So if my business partner and best friend Mark McEvely were here with me in the podcast, I know that he would immediately speak up and talk about how market sector rotation tends to be the lifeblood of an uptrend or a bull market. Opinion, and I agree with that opinion. What you need is sectors to rotate back into favor and have leadership. And if you think of it as kind of stair-stepping the market higher, that's not a bad thing in my opinion. So I will bring this topic up when Mark is back on the podcast, but wanted to share that with listeners that not all is bad, that you really had some sectors do well on Monday despite the headlines you might have seen in the indices. My next piece, dip buying in the data during Monday's sell-off. This was a post that I saw by a Bloomberg TV news anchor, Katie Greifeld, on January 28th. Jenna will put up the X post on our YouTube video. This will be in our show notes. Katie mentioned, and I quote, there was a ton of dip buying during yesterday's sell-off. And yesterday's sell-off, again, listeners, she's referring to Monday. And it said SPY, which is a popular exchange-traded fund that would track the S&P 500 index, that was had inflows of $6.1 billion on Monday. The QQQ, that is a popular ETF that tracks the Nasdaq 100 index, had inflows of 4.3 billion. That's the biggest one-day inflow, Katie said, since 2021. And the SOXL, that is a ETF that replicates 3 times the movement of the semiconductors index. Definitely not advocating that, but just showing you the money was flowing in at a rate of 1.3 billion on Monday. And again, I want to say this is not recommendations for or against any of these ETFs, but rather illustrative that there was, at least in the data, some pretty big dip buying on Monday. And I think it goes to show you that there is just, in my opinion, some dry powder on deck and people are looking to get in when there's kind of these really quick reactions in the market. And that is not a negative. As I would classically say, and Jenna will love this, that's not bearish. So the next thing I have is up for a history lessons about drawdowns. So at the top of the podcast, I was talking about Nvidia as my example. And if we go back to Monday, as I mentioned, the stock was down 17% in a single day. So this next piece is a post by Mike Zaccardi on January 27th, and he posted this at 3:33 p.m. on X. Jenna will put up this chart for our YouTube viewers. What this chart illustrates is all of the drawdowns in this specific stock, Nvidia, going back 2+ decades. And you're going to gather very quickly that volatility in these single types of names can be dramatic at times. So here's my prepared note for my listeners and viewers. A lot of investors do not have the ability to hold through drawdowns like this that's illustrated on this chart. You'll see, for example, in 2022, the drawdown in this name was over 60% of a sell-off. Investors tend to chase the upside and sell into these corrections. It is a long-term investor that tends to benefit. So that is my main point that I will throw out there. And ultimately, we just got to recognize that on these single securities, everyone talks about maybe how much money they made in XYZ security or what the trailing performance has been per year on XYZ security for the last 5 or 10 years. But what's not highlighted are those periods of volatility where you have a drawdown of 20, 30, 40, 50, 60%. And you really don't have people at the water cooler talking about how they had diamond hands holding the security through that. Words of wisdom that, those types of sell-offs in a single security are not uncommon. And it's another reminder as to why you got to look at single security concentration within anyone's portfolio. So now I'm going to change gears away from some kind of real-time market news and just do a couple bits of education. So the next thing that caught my eye is an interesting data point about Chinese car exports and how it's beginning to hurt the economies of Japan, Mexico, Germany, South Korea, and the U.S. So this was a post that I saw on X by Michael Arunet, and I hope, Michael, that I properly pronounced your last name. It was a post that I saw very recently. In this illustration, Jenna will put up for our YouTube viewers, this will be in our show notes. And what it's illustrative is the number of cars exported, and the chart goes back roughly about a decade. And what you're going to see is since 2020, this dramatic rise in Chinese car exports. And the post by Michael says, quote, 13 million jobs in Europe are now in the automotive sector. European car makers not only lost their market share in China, Chinese car exports to other markets go through the roof. You can clearly see that illustrated in this chart. Europeans simply cannot afford losing U.S. market due to tariffs as well. Better be nice to Trump, end quote. Well, what you're going to see again very dramatically by this chart is the Chinese have innovated. They are exporting a lot of cars. They're at good price points. I've even heard some news headlines that the CEO of Ford was driving either 1 or 2 different Chinese-made cars for like upwards of a 6-month period. And he was coming out saying, listen, this is a really good product. We really need to step up our game. I just throw this out there because the European economy is very heavily invested in this type of industry. And it's definitely something I would keep my eyes open on. Next, I'm going to switch gears. I'm going to talk about the dollar. Over the past couple of months, Mark and I have talked about the US dollar a couple of times. It's been a headline, obviously, because of the new administration. So far, the dollar seems to be following a similar pattern to what we saw in 2016 and 2017 when Trump got into office the previous time. So this is a post by Tom McClellan. Tom posted this on January 28th on X. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. And Tom says, and I'll quote, "Final for now, dip due this week in the dollar index before a rally to March, assuming that continues to follow the pattern of the last time President Trump was inaugurated." So the reason I'm bringing this up is, do I think it's going to exactly follow what happened in 2016 to 27 to a T? Probably not. But you are seeing somewhat of a similar pattern so far. And I just want to throw it out there that if history does repeat itself, you'll probably see some weakness in the dollar index as we go into the spring based upon history serving as just a general guideline. Now, the reason this is also important is that when the American dollar is really strong, it makes our exports more artificially expensive when we go to those other markets. So in flip, when our dollar is very strong, it makes us be able to afford our imports that we bring in. They tend to be a little cheaper because the dollar's strength. So I just want to kind of throw that out there. I find it quite interesting that so far it's been following the historical pattern of the last Trump administration pretty close. And I'll be curious to see if it continues to do so. All right, switching gears again. My next piece is in regards to just overall, let's just call it conditions in the market and in the economy. So what caught my eye is a piece of research from Goldman Sachs that is about the, quote, "the current combination of macro conditions," and it goes on to say, "has historically been supportive for risk assets." And when you think of risk assets, I want you to think of things like stocks or equities. So this was a post by a friend of the podcast, Mike Zaccardi. He's a CFA and CMT. He posted this on January 29th at 5:56 a.m. And this chart by Goldman is illustrative, showing a 0 point of when the Fed first starts cutting rates. And as a reminder for my newer listeners and viewers, the first interest rate cut of the current cycle was in last September of 2024. And what you're going to follow is in the orange on this chart is where the market, in essence, is at this time, global equities. And what you're going to see is if we don't have a recession, then obviously you can see illustrative here going back in time, the performance of risk assets tend to be good. And I want to throw this out there because obviously one of the things that can derail the stock market is heading into a recession. And what I'm seeing right now based upon the data, anything can happen, of course, is that in the immediate future, the next 1, 2, 3 quarters, I'm not seeing the threat of a recession imminent based upon the data that I'm seeing. Obviously, there's a lot of changes by the current administration. Anything's possible. We need to keep our ears and eyes open for that. But this is definitely not a bearish piece of research. I want to throw it out that way. Next, and this is going to be kind of my final piece, I'm always looking out for news that is not being talked about in either the mainstream news media or on Wall Street. And if Mark were here, we'd have a roundtable about this because we've talked about it quite often in the podcast over the many years we've been doing this. And here's the point. It's the news or the themes that the market is not pricing in and or talking about that can derail it. If it is a known, let's just say, concern or issue for Wall Street, historically it tends to do a pretty good job trying to price in that risk. It's when you have news headlines hit the market that were not priced in or the risk wasn't being talked about that tend to kind of have those shock moments in the market where you kind of get these kind of quick and abrupt sell-offs. That's my words of wisdom. That's my years of experience speaking. Well, this is a post I saw by Tracy Shakard, and Tracy posted this on January 28th on X. Jenna will share this this post for our YouTube viewers. This will be in our show notes. And what Tracy mentioned here is a post that talks about the continent of Africa being in the midst of a wave of violence. And what Tracy put on this is, and I quote, "This is definitely something to keep an eye on." And what you're going to see very illustrative here by this post is there is a lot of conflict going on in the continent of Africa. And we got to be cognizant of a lot of the raw commodities and materials that are exported from this country. And I know that you've had a lot of the, I would call, previously imperial nations who have really cut back on a lot of expenditures. I know there's a lot of spending, in continents like Africa. And you've really kind of seen underneath, I think, the news headlines, this kind of rise or wave of violence across the continent. And I'm not saying this to immediately raise alarm bells from an investment standpoint and how it could affect the global markets. But I also want to throw it out there that this is not really something that is a mainstream news media talking point that I'm really seeing in the markets that's even remotely priced in as a risk. And these are the types of things that I think as wealth advisors that we monitor and we keep an eye on. Could this turn into something that starts to affect markets? Possibly, of course. Could this not be a factor in the markets anytime soon? Of course. But I think it's important to highlight things that are potential concerns in the market. And I'm sad to say that this is one of those topics. It's sad to see this from afar. I know that there are probably populations that are being adversely affected, and it's sad to see. And so I'm looking at this, of course, from the investment lens. That's my professional job to do so. And it definitely is a topic that is not being talked about in the mainstream news media, in my opinion, at least in the financial markets. So that is kind of my podcast for the week for episode 286. My final comments is earnings season is, we're definitely in the prime time peak of earnings season. And as a reminder for our newer listeners, that is a time where every quarter publicly traded companies have to report their earnings to shareholders. They'll tell us generally how they did for the previous quarter, what their financial results are. They might even go as far, some companies, to provide forward-looking guidance. A lot of companies during these conference calls will even take questions from research analysts and or investors. And they tend to be times where a lot of information is provided. Hence, you tend to see a little bit more volatility in individual stock names surrounding these announcements. So just know that if you start to see a little bit more volatility in an individual name up or down, but you look at the indices and maybe they didn't do much, it's probably because they reported their earnings and we're just in the peak time of receiving those fourth quarter earnings from last year. We're getting that information now. So I'm going to sign off. Thank you for listening to episode 286 of the Independent Advisors Podcast. We'll be back with you next week with episode 287 with a special guest. Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.